Hello, everyone, and welcome to our K-1 and pass-through series, entity series that is. I'm Dave Stauffacher, the Senior Credit Trainer with Lenders Online Training, where we help lending and credit professionals say yes to good loans. My colleague and another Senior Credit Trainer with Lenders Online Training, Joe Davis, is signing on with us today. Joe, it's great to have you. How are you?
Doing great today, David. It's a beautiful day here. Anxious to dive into some content.
Excellent. Well, Joe, you've had an opportunity to review some of the questions over the months and comments from our viewers. What's on their mind today?
Man, we love getting these questions. It's how we build content. It's how we're making sure that we're responsive and giving the information that people want. But what's on people's mind today? Which K1 should I get when a high net worth individual owns multiple pass-through entities? Interesting. So, David, does it make a difference if the individual is high net worth or not? I thought guidelines were guidelines. What gives?
That's a great question. If Linda was here, or if I would have had my T-shirt on, it says "It depends" on the front side, and check your guidelines on the back. I am going to get one of those T-shirts for one of these shows.
Classic.
No, it is a great question. In my career from banking, I am a consultant with the SBDC as well as Lenders Online Training. Guidelines do vary from bank to bank. You've seen that in the various banks that you've worked at. Sometimes it reflects on the type of loan that you're dealing with, the type of borrower that you're dealing with. Definitely depends on the size of the loan relationship. So we do see a variety of differences in mortgages, private banking, business loans, general business, commercial real estate. There are varieties. So I guess what I'll answer the question is from the perspective of how you might decide what your guidelines would be if you are responsible for establishing guidelines, or maybe even how you would interpret the guidelines that exist. My preface here is on many occasions, I think the borrower really doesn't know what type of forms or schedules or that are actually included in the income tax returns. And I don't mean that to belittle the fact that some tax returns, there's so many documents there that you get. If I'm reaching out to my borrowers, say, can you share with me the 2024, 2023 tax returns? They will probably just open up their packet that their accountant gave them and send to it, not even knowing what forms are in there or not. So quite honestly, they just don't know, and they might be missing a K-1. On the other hand, if you're a CPA, most likely you're going to send all the information and the K-1s are going to be concluded. So to simplify the process, you either get all of them, kind of if your guidelines would, that's what it means, they want it. Or if you have very few borrowers you're needing for, get them all. The other option is don't get them. Now, once again, there's going to be guidelines. It's going to tell you which ones you can, which clients settings that you can avoid those. But if you're lending to if you're lending to the entity alone, and I've done this in the past where I'm lending specifically to the entity, I do have guarantees, but the entity itself is strong. Right? Strong financial statements, strong cash flow. Our collateral position is strong. We've had a long-term historical relationship. If the K-1 is not in the personal tax return, I'm not going to worry about it so much. Now, if I'm lending to the individual, kind of a private banking relationship, once again, I'm going to look at their personal financial statements, seeing if there's any liquidity on that statement that they could supplement the cash flow if need be. If it's a strong personal financial statement, not a lot of debt, etc., has an excellent credit rating, quite honestly, I may not ask for K-1s for that because I'm lending to them. Now, maybe they're they're a passive investor in a K-1, right? They're not active in the business. I may not ask for the K-1 there. So I think it does depend on the relationship of who you are lending to. Now, my professional position, especially when I'm in the consulting relationships that I do, I work as a conduit between the customers and often the bankers. I kind of get all of them. Like I said, I like to wrap my arms around all of them because I'd like to know what's going on so that the picture that we're passing on to the bank, that it answers many of their questions. I know I shared this story before. I do in some of our groups in the setting. A few years back, I was working with a relationship that was looking to establish a very large hotel type setting. And the partners involved, 2 of them at the time, had 8 other partnerships. 8. Some of them, there were just those 2, and then there was some other fits. So 8 partnerships. So they're all going to get K-1s. Most of us bankers, we want 3 years from historical reference. So just imagine I had 24 plus their personal, 27 tax returns that I had to deal with it because I wanted all, but I felt that it was important to understand them. Why? Because each K-1 kind of represents some type of unique income stream. We got to be aware of that. So even though it's the taxable income that flows through, but there's other means where cash flow might be coming through, I think I want to know that. We want to know how strong those relationships are with those companies because we know in our days of credit, if 1 or 2 businesses struggle, the other 3 or 4 or 5 are going to somehow help them out. We just we have to find it. And sometimes as owners of companies, they're not trying to deceive anybody. They're just making sure that payments, and they don't know which pocket to grab from, and they'll deal with it later. That's what we bankers often have to deal with. So I'm a strong believer. I like to have a full picture of pass-through income, even if I don't need it. Now, I might be asking for a little more information for the borrower. I'm not looking to upset them or anyways. If they push back or reject, I mean, I simply can spin around the conversation. But I think it's important to kind of have a full wrap around it. That's my personal opinion. So basically, Joe, I think that's it from my side of what do I do. This could be a short live stream, which normally doesn't happen with me. Is there anything else you might want to add?
First time ever. Yeah, a couple things, David. I really like that you talked about guidelines because it depends, right? But guidelines are exactly that. We're often making judgment calls based on the scenario. There are endless varieties and combinations of entities and financial strength, and you really have to tailor your approach to each individual standpoint. So as in life, very few things in banking are just straight black and white. We're often dealing in the gray. We're operating in the gray. So as part of their learning curve, I'm sure you've seen it in your career as well. Newer bankers, newer credit staff, they take some time to figure out what is material versus immaterial. They take some time to figure out what is nice to have versus what they need to have, which is a lot of what you're talking about. But this is a really good example of that. This experience comes with time. It comes with at-bats, but it also comes from formal credit training, like what we're talking about with Lenders Online Training, and discussing with more seasoned staff, perhaps someone with a little bit more gray hair on their head in order to make these judgment calls, for sure.
So yes, definitely gray hair, maybe less gray hair, but yeah, that's what I'm here for. We love we talk about these issues when we're in our formal credit training, foundational credit training. It's interesting the dialogue we have. We want you to make good loans. We want to discuss all the different opportunities and provide some insight, some seasonality to it, basically seasoned approach to help you as lenders. I mean, so short and sweet. Our K-1 series that talks about specifically pass-through entities and how they enter the mix, probably one of the most complex topics, especially when we're doing a global analysis from various partnership returns to S corporations. Then you throw in an occasional C corporation, which isn't a pass-through, but how does it enter the whole picture? I think it's important, especially in small business accounting and small business lending. So if you need any foundational training to make sense of all this stuff, gain some confidence, maybe the ability to analyze and explain tax returns in addition to financial statements for your borrowers or yourself, quite honestly, your entire team, let's connect. We'd love to be able to chat with you, tell you a little bit about what we do, see how we can actually help your organization with its credit training. Reach out. Lastly, questions, just like today's question. Thank you. We really appreciate the comments. We appreciate your questions. If you have any other questions, reach out to us. Call us at or email us at experts@Lenders Online Training. That's experts@Lenders Online Training. Myself, Joe, Linda will respond back to you quickly to answer your questions. With that end, I want to thank you again for coming. We appreciate all these. Until next time, I wish you have a great day. Take care, everybody. Bye now.
Bye bye.